we hear and we believe that Bessent and Druckenmiller are speaking 2, 3, 4 times a week. So the good news is the United States Treasury Secretary is really very close with some of the greatest minds in the business. Whereas the Yellen team, my friends on the Hill would call the Yellen Treasury the faculty lounge. In other words, no offense, but brilliant academics, but nobody was actually taking risk and sat in a risk-taking seat.
Larry McDonald, founder of the Bear Traps Report and author of the bestseller, How to Listen When Markets Speak, and certainly a friend of this show. It is so great to welcome you back on. Great to see you as always, Larry. We always appreciate your presence on the channel.
Thanks, Julia. Great to be back.
Certainly. And it's been a while. I was just chatting with you. We spoke in mid-April and I feel like it's been too long. So I'm really excited to have you back on today. Let's start, Larry, where we always start, more of that big picture, your assessment of where we are as it relates to the economy, markets, your outlook. And as you know, Larry, you can take all the time you need to set the table when it comes to that bigger picture, more of that macro view.
Well, what we did in our client trade alerts, they go out on WhatsApp and email and things like that. But we got very long, what we call high beta names in April. And all that means is equities that move more than the market. So your uranium names, your copper names. And now we're kind of taking down a little bit of exposure to those high beta names because the market's really frothy. Some of these names, like things like Micron, are up 110% off the April lows. Same thing with something like Cameco, highest RSI relative strength in one of the highest levels in years. And so extreme overbought conditions. A lot of people are chasing these highs, and what we're doing is we're just like, okay, we're cutting the position in half. We're not leaving the position, or we're selling upside calls. On one of our favorite strategies is when you have a position in a high beta sector and you're up, say, 100%, 60% in a short period of time, and you've got a high RSI, you want to sell that upside call, taking the premium, then you're the casino. So that's one of the things we're focused on is kind of just anything high beta is now you want to add high beta into fear and panic, and you want to lighten into complacency and kind of extreme optimism.
Wait, can you explain that last part about high beta and add high beta into fear and panic, and you want to lighten around complacency? Can you just reiterate that and explain that for me?
Yeah, because what happens with these high beta sectors is there's a lot of tourists that come in, right? So your uranium has had 4 different moments in the last 5 years where it's high beta, it moves more than the market, you make highs, and then you get all the tourists come off the bus. and these are weak hands. These are not real investors. They're just chasing. And so when you have a high beta sector, it's really important when you're at this kind of point in the market and you're this extended, you want to be selling upside calls into that complacency, that Pollyannish extreme optimism. Whereas what we've done on this show and in trade alerts, when you get that real fear in the Rose Garden and Trump and the Trump, the attitude about the belief in the the Trump Bessent team was like the belief in the Trump Bessent team from April 1st to the 20th was literally at the lowest point. And now the belief in that same team is at an extreme optimistic point.
Mm-hmm. Extreme optimistic point. And as you point out, overbought conditions. Okay, I want to move on to something you had a note that got my attention. I would love for you to frame it up because you were writing and warning about a Liz Truss moment for America. So can you, one, walk us through the specific mechanics and this thesis that you have?
Okay, well, so one of the keys that we run a Bloomberg chat behind me with hedge funds, mutual funds, and pension funds. And what we try to do is scientifically, meticulously measure the life of a narrative, a belief system So things come into the market. So this Liz Truss narrative, all it means is like a massive bond panic moment where the bond market really has a capitulation collapse, the Treasury market. And this thesis has been out there. I mean, we started to hear this from Jeff Gundlach. We heard this from Ray Dalio. We heard this from Paul Tudor Jones. So it was so well known. And we kind of reached a panic moment earlier in the year where, people were really selling bonds. Risk parity, which we talk about in our book, How to Listen to Market Speak, the risk parity 60-40 portfolio has really died. I mean, it's dramatically underperforming in recent years. And we've gone, as we've talked about on this show, we've gone to maybe a 30-40 portfolio with stocks, bonds, and commodities, right? So the Liz Truss moment around bond panicking is very, very, very well known. And so now we fast forward to kind of a newer narrative. Scott Bessent worked with Soros, Stan Druckenmiller, probably one of the most famous investors of all time. They're really good friends. We hear and we believe that Bessent and Druckenmiller are speaking 2, 3, 4 times a week. So the good news is the United States Treasury Secretary is really very close with some of the greatest minds in the business. Whereas the Yellen team, my friends on the Hill would call the Yellen Treasury the faculty lounge. In other words, no offense, but brilliant academics.
Not practitioners.
But nobody was actually taking risk and sat in a risk-taking seat. Now, so imagine if you're Bessent and Druckenmiller, you're in the Treasury, and you hear for months and months and months about this Liz Truss moment. And all that means the big bond panic. And where this comes from is, if you think of the debt ceiling. So you've got the debt ceiling from January to this week there's been no new debt issuance, none. And so we haven't increased any debt because we hit the debt ceiling. So they can't issue any new debt. If a bond matures, they can issue one, but no net new issuance. And this has been going on for a long time. And this is the United States of America. This is a very, aggressive spending Washington, group, a cabal in Washington that is addicted to overdosed fiscal spending. So when they go long periods of time with no bond issuance, there's a catch-up period that can be pretty violent. And that's what's coming at us right now. So we raised the debt ceilings through this big, beautiful bill. Now, between, say, August 1st and December, it's 1.7 trillion of bond issuance, 1.7 trillion, about 600 billion more than last year. So that's what got everybody kind of excited, or I should say panic, concerned about this crash in the bond market. Bessent, though, and Druckenmiller have been out there with his bag of tricks. And they basically put a bunch of guns on the table. And they've said basically to the bond vigilantes, you guys want to short our bonds? Well, we're going to create things that are going to make your life miserable. and this kind of new narrative has been out there for like the last 5 weeks around the SLR, a supplemental leverage ratio. And all that means is forcing the banks through regulation to own more treasuries. Right now, the banks own 2%, Julia, less treasuries than they did 10 years ago. So there is some room there. We calculate 300 billion of potential bond buying. You put a gun on the table and you say, listen, banks, you're going to buy more treasuries. Then there's the Wells Fargo cap. They did the same. They're lifting this. That's very similar. That's about 50 billion. Then there's things like the stable coins and, different pieces of legislation on the Hill that will kind of like incentivize stable coins to buy more T-bills. And so there's all these things. And then there's the last thing that they've been floating the last week is issuing less duration. So if you're the Treasury Secretary, you can issue 30-year bonds, 10-year bonds, 5-year bonds, 2-year bonds, or 1-year notes or bills, or 6-month bills. So what Bessent is basically saying is he's going to hang out a lot like Yellen did on the front end. Right now, we thought that they would be terming the debt out by now, but for right now, they're not going to do that. That means we're going to have a whole bunch of bill issuance, one year bills, 6-month bills. All that means for people watching us right now is the dollar, which is really washed out. I can send you some charts. The dollar probably comes into a counter trend rally because think about the United States. We're issuing this extra 600 billion of debt. A lot of it's going to be on the front end. So that means 6-month bills, 3-month bills, 1-year bills, maybe 2-year bond, 2-year notes. And so if you do that, your yields in the United States are going to be kind of moving up greater than the rest of the world. That's going to bring some money into dollars. And so that's another reason why we're taking down some of our high beta commodity names into this strength, because the probability that you get this dollar counter trend rally is pretty high.
Okay, that's interesting because the dollar has declined this year. That's gotten a lot of headlines in the financial media, but you're talking about a counter trend rally. Can you put some more meat on the bones? Can you explain like the mechanics of that for us? Because that is really interesting.
Well, in our book, there's a chapter on the dollar. And so we've been big dollar bears, and our entire model portfolio at the Bear Traps report is it's very short dollar because we were long a lot of commodities, we're long a lot of the copper names, long the lithium names. We can get into coal. We're long a lot of gold miners. And so what we just want to be careful here is because if the Treasury Department has to issue this Liz Truss moment, all these bonds, and they're not going to issue on the long end, they've already told us that, then they're going to push up that front end of the curve. So those yields, because they're selling so many more bonds, that's going to push up yields. And so if you're a German pension fund or a pension fund in Asia, Canada, you may be less comfortable with the Trump team through all this drama. But if the yields are up on 3-month bills or 6-month bills and those or 1-year bills, those yields, if they get up high enough, that's going to suck money into dollars, and the dollar's going to strengthen in a bear market.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold, paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. Okay, but why would it suck it into dollars? Is it because like people would want to go into those shorter term?
So think about if you want to buy treasuries,
right?
You need dollars to buy them. Like
there you go.
So in other words, you're buying treasuries. That's long dollars.
Because people wouldn't mind the duration then, because it's shorter duration.
Right. Exactly.
Okay.
And,
interesting. What about long bonds?
Well, long bonds that's the problem is the long bond, like globally, this week's a big week. I mean, the JGB, so the Japanese bonds, the UK bonds are all breaking out. The UK bond level is through the Liz Truss panic moment. And that Liz Truss is a politician in the UK. Mm-hmm. She became prime minister, and she issued a very aggressive kind of tax cuts. She issued a fiscal plan that the bond market just rejected. And that was the original Liz Truss moment. And she was thrown out of office because of this. And so globally, and this is a big concern from a lot of different funds, and it's a big concern in Washington. Globally, the global bond yield anchor was Japanese JGBs. Like they were keeping bond yields lower. And now they're breaking out. We've got bond yields breaking out in the UK, Japan. That's kind of taking our bond yields higher on the long end. And so at the end of the day, I'll give you an amazing stat. The EMLC, which we've talked about on this show, is the Emerging Market Local Currency Bond Fund from JP Morgan. That is outperforming the TLT, which is long duration treasuries, by double digits in the 1 year, 3 year, and 5 year. Can you imagine that? I want to say this is the emerging market local currency bond fund. I mean, this is one of the more, it's speculative. It's not, but it's because there's been interest rates have gone up so much in the United States, and we've had inflation and we've had, $2 trillion deficits. People are more comfortable buying to some degree a portfolio, this EMLC, and I could sing in the chart, the EMLC versus the TLT.
What does that say then? Like, what does that say about the environment then?
Well, yeah, people just, nobody's made money in long duration treasuries for going back to 2022. But before that, every year they were printing money. And so what's happens is every day, every minute, every hour, every day, every month that you go when duration's not making money, bondholders are moving out of long-term bonds, out of paper certificates into commodities, into other things, into Bitcoin. And so what's happened is since 2022, the Liz Truss moment, and we had our bond yields in the United States were ripping higher. All we've done, there's an Apple bond, Julia, there's an Apple bond that was issued, a 2.55% bond that was issued back in 2020, 2.55%. It matures in 2060. It's trading in 56 cents on the dollar. That's the type of pain that's out there in long-term bonds. There's $5 trillion of family, say what we call in the family space and construction and multifamily, and then in what we call commercial real estate, $5 trillion of debt. And a lot of that debt was issued when rates were really low. And so one of the things that the clients are talking about is the banks have made this big run, but because of this bond market stress, these higher yields on 10s and 30s, the amount of when interest rates go up, bond prices go down. That's why that Apple bond's trading at 56 cents on the dollar. Can you imagine where all of these bond portfolios in commercial real estate and multifamily are? They're all down at 50 cents, 60 cents. There's just billions and billions and billions of dollars of losses. And that's why the bond market is so important right now.
Yeah. Oh, man. Okay, so let me ask you this then, because as you're pointing out, Scott Bessent has this bag of tricks. Is it enough? Will it be enough? Like, how much Treasury buying power will this actually create? Because it sounds to me like there's a mess out there.
Right. So I did a speech at the University Club a couple of weeks ago, and we had a great debate where we put out this presentation on the bag of tricks, and there were a number of people that really prominent bank analysts in the room, and they pushed back, and they just said, listen, the SLR has buy potential, but we don't know the timing of this. And in other words, it may take a while for the regulation and for the banks to actually get more involved in owning more treasuries. And so, yeah, there's a risk that the bag of tricks doesn't really get to the bond market on time, like the ambulance doesn't get to the crash scene on time. But over time, make no mistake, this is financial repression. This is what we talk about in our book, How to Listen to Market Speak. You and I have been talking about this.
Explain that for folks, the financial repression part.
Yeah, you and I have been talking about this for 2 years, and it's finally been happening. And that's why there's a move into hard assets, commodities, emerging markets, right? So those are the things that do well in a financial repression world. All that means is that when you have a $37 trillion debt hole, there's two ways out. There's financial repression, or what's called a debt jubilee, which was talked about in the Bible. Many civilizations have had debt, which is just a big, big bond default. What we've seen in Argentina, for example. Debt jubilee, or inflate your way out through. And all financial repression means is using artificial means to suppress or hold interest rates below the rate of inflation. You can do that with QE, where the Fed's buying bonds, or the Fed can force the banks to buy bonds using their balance sheet. And so you can do this, but it takes a while. And whether or not it gets there on time, I suspect that the beast in the market, that serpent inside the market, even though Bessent has put these tricks on the table, these guns on the table, the bond market actually rallied from 515 on 30s to 471, and now we're back near 5 again. So Bessent was able to get yields from 515 to 471 after the bag of tricks and putting all these guns on the table and threatening the bond vigilantes. But what's amazing is that even after all that, bond yields are back up near 5% on the long end.
So the vigilantes are back then.
They're definitely back in Japan. They're definitely back in the UK. And as those bond yields rise, it kind of, to some extent, it can drag our yields higher as well.
Mm-hmm. Yeah. Okay. So you and I have talked about this. Like, this is a whole new paradigm or regime for investing, or like, as you put it in the book, a radically reshaped economy. And would it be fair to say then, like with the move to hard assets, I think you and I have talked about like a renaissance in commodities investing. I would love to talk about the commodities part of this, where we are as it relates to that, and the opportunities there. I heard you say copper. I've heard you talk about gold. Would love to just kind of get an update on where you want to be as it relates to those hard assets, this kind of commodities renaissance, if you will.
Okay. So these types of companies are high beta, and that means they move more than the market. So first of all, when you take a position, you got to be ready to buy on weakness. The copper names have made a big move. We think they're up. We think the copper names are up 200-300% over the next 5 years, maybe more. We've talked about on this show our bullish thesis around the Ukraine rebuild, right? Around the rebuild in Gaza and Iran, all that copper for those structures. You're talking about thousands and thousands and thousands of structures. Los Angeles rebuild. Robotics, 2 million robots. 2 million robots, which is nothing. Some of the estimates are 50 million, 100 million robots over the next 10 years. But robotics is going to consume a ton of copper. And then there's the rebuilding of the power grid in the United States, which is ancient. It's like a 90-year-old man you're trying to drive, 99-year-old man trying to drive a Ferrari with artificial intelligence, right? So this whole artificial intelligence up move in semiconductors is complete BS, because really these companies can't grow at the pace to keep up those valuations without a lot more copper. And so the whole artificial intelligence trade depends on copper. If you look at copper politically in countries like Panama, Peru, Chile, we're just not producing enough of it globally to meet demand. And so we're going to be in a multi-year bull market. The COPX, we've recommended to clients over the last year. Freeport FCX, First Quantum. We've had multiple trade alerts in these over the last year. Right now, we sold a little bit of Freeport in the last week or so, because it's made a big move on the Trump Section 301 tariff investigation. Trump came out with the tariffs. So the U.S. is still a big tariff importer, and most of our copper is imported in the United States. So what Trump's trying to do is the Trump team's trying to get the United States into a more independent copper production phase, which we're going to need to produce our own copper. But all this is going to be very inflationary. So at the end of the day, as we move into the 2025 to 2035 world, that whole new portfolio construction that we talk about in the book has been starting to play out, where you're long the copper names, the lithium names, some of the gold and silver miners, companies that own assets in the ground, because once you're in that new higher bond yield, higher inflation regime, companies that own assets, natural gas, oil and gas, we love the oil service names here, we can get into that. But companies that own assets, those types of companies in that kind of new regime with higher interest rates, higher inflation, multipolar world, global conflicts in the Suez Canal, in the Middle East, supply chains that just are not working anywhere near as efficient as they used to, reshoring, all this is really inflationary. Tariffs on copper, that's going to be inflationary. And so you're in a whole new regime, so you need a whole new portfolio construction.
Yeah. I know we're about at time here, Larry, and I want to be mindful of your time. Before I let you go, let me ask you this question, and it'll be a two-part question. What is that risk for you right now that is maybe keeping you up at night, that's on your mind, that's not getting nearly enough attention? And then to follow on to that, what is something that's making you optimistic?
Well, it's on the risk side, it's that the banks are so exposed to interest rates. We had that 2023 moment when rate shock created a banking crisis. And so if they lose control at the long end of the curve, it will create a big move down in the banks. And the banks are just long too much, like I said, $5 trillion in commercial mortgage-backed securities and what we call multifamily alone. That's just one space. So that's the big thing, is that interest rate risk for the banks. We're seeing a lot of clients shorting the banks. JP Morgan's at 2.4 times book, never traded there before. Jamie Dimon has sold 25% of his stock in the last year, the most aggressive pace he's ever sold the stock. Warren Buffett has sold 25-30% of his Bank of America in a very short period of time. Both Jamie Dimon and Warren Buffett are selling the banks at an alarming, like never seen before pace. That tells me that you want to be fading the bank move here. On the optimistic side, it's just that if you're going into this kind of like fast, more higher inflation, higher, interest rate regime, that's going to be really, really bullish for commodities versus equities. It's going to be bullish for emerging markets. And so there's a lot of things to be optimistic. And then most importantly, this lithium trade now with solid state batteries and more kind of longevity for electric vehicles. And think about the burnouts in the United States around the power grid. You're going to need a lot more better battery technology, and that's lithium. And the ALB equity, we've done trade alerts in the last month on ALB. It's washed out, bombed out lithium miner with exposure to Chile. Chile has an election coming up in November, and we see a market-friendly shift there from a socialist government to a far more conservative government. In that case, a stock like ALB equity, Albemarle, could be up 100, 200% over the next couple of years with that kind of political shift.
Yeah. I love how you always give actionable trades. Let me ask you one more, if I can sneak it in, because you mentioned higher inflation, higher rates. I'm looking at the prediction markets, Kalshi, number of rate cuts in 2025, forecasting, let's see the forecast here. We have 38% are forecasting 2 cuts, 23% 1 cut, 18% 0 cuts. What do you think about rates going forward? What's your kind of prediction there?
We're gonna have a far more dovish Fed chair coming in. The political pressure on rate cuts is high because interest on the debt is about $1 to $1.1 trillion. So they have to get rates down no matter what. And once again, that's financial repression. So I'm still leaning toward rate cuts, even in a relatively strong economy, because the powers that be in Washington just know that we have so much debt and so much interest costs, $1 trillion, greater than it's greater than defense spending as a whole. Yeah, they're going to have to cut rates. I see at least over the next year, at least 100 basis points of rate cuts.
Yeah, and even Kalshi on the prediction markets, the forecast for our national debt is 39 trillion this year. That's what folks think we might get to. I don't know. That's I wouldn't be surprised. But Larry, I always enjoy having you on the program. I know the audience loves having you too. Before I let you go, if there's anything you want to plug, anything you want to leave this audience to think about, please do. I will link your book because this book has been incredible over the last year, and I congratulate you on all the success. I know it was a team effort, but really congratulations to you and the entire team.
Oh, thank you so much, Julia. And I'd say the only other thing to bring up is just the coal names were really overbought after Trump won. And it was one of these Trump trades where it brought in a lot of the tourists. And there's been a really violent move down in some of these coal names, Core Natural Resources, CNR, or the COAL ETF, the coal ETF. We're seeing a dramatic outperformance in recent weeks versus commodities from the coal space. So that's an area where we're seeing clients come back into, and you get very cheap valuations on Weatherford, WFRD, and CNR, which is Weatherford's in the oil service sector. We think the Trump team needs to take that offshore drilling as a percentage of U.S. production from 12% to 18%. Offshore drilling, WFRD, SLB, OIH, those are your offshore servicer type plays. And then in the coal space, it's Core Natural Resources, CNR, trading at like 3 times EBITDA, 3-4 times EBITDA. It's very cheap.
Larry McDonald, founder of the Bear Traps Report. Thank you so much for being so generous with your time, all of your knowledge, your wisdom, helping us all learn and get better, and for all of your great ideas. Really appreciate you, and I look forward to our next conversation. Thanks again, Larry.
Thank you, Julia. Thank you.